Hi everybody, it's Clinton. Just getting going here. And I just want to welcome everybody. Hopefully everybody's having a great day. Thank you for joining us here on our rental property webinar. Hopefully everyone can hear me. At the bottom of your webinar screen, there's a place for you to ask questions. I know you had the option to ask some questions when you registered. We'll try to answer some questions at the end. So if anybody thinks of anything as you're going through, certainly you can put the question in here, and hopefully we can get them answered for you, and hopefully it'll be a great information session, and you'll be able to get as much information from the webinar as possible. So let me just make sure, yeah, it looks like all the audio is good. We have several people on here, so happy Tuesday. We'll get right into it. For those of you who don't know me, I'm a mortgage broker in Halifax, and I've processed over 5,400 mortgage applications in the past 10 years. We've helped many first-time home buyers, and my goal is to educate consumers and help them become homeowners. And today in our webinar, we're going to talk a little bit about rental properties. So what it looks like for buying maybe a property that's not going to be your principal residence. The reason I really founded my own brokerage was to be offering something that's more customer oriented. And my clients' financial well-being is really my number one focus. You know, our clients are really our customer, and the lenders, we think we just lend the customers to them. So if you've ever played the game of Monopoly, you know that rental properties are very beneficial. They serve both as a source for immediate income as well as a long-term investment when you retire. So during our webinar, we're going to talk about what type of properties qualify as a rental. We're going to talk about more about owner-occupied rentals and second homes, what percentage is needed for a down payment, what can I use for my down payment, how is the rental income calculated and verified, what type of credit do you need, your personal name versus a holding company, and is there anything else that I need to know? So this is what we're going to be covering. And we've also given the opportunity for you to ask a question when you've registered. So we've also grabbed some of those questions, and I'm going to answer those at the end. So we'll get going here. What qualifies as a rental? What type of property? Rental properties come in all shapes and sizes. Qualifications for rental properties are just as unique as each situation. The type of property and your living arrangement will determine the required down payment as well as financing options. So a little bit more about that. And we get asked these questions all the time. Typically in our channel, which is the residential channel, we finance rental properties anywhere from a single family home up to 4 units. So basically that means that typically it's all residential, no commercial component, and a maximum of 4 units. In terms of a number of properties that we finance, typically the rule of thumb is 5. So we could have maybe 5 properties, including your principal residence, maybe 6, just depending. Different lenders have different requirements. And the maximum amount of units for each property would be 4. Anything over a 4 unit would need to be through the commercial channel, which is a little bit more costly, and it's a longer process. So typically residential is the easiest path, and typically we can also provide residential mortgage rates to someone buying, you know, a residential rental property. More about owner-occupied rentals and second homes. So this is a great question. I get asked this question every day. So typically an owner-occupied rental could be a single family, maybe with an in-law suite. It could be a 2-unit, a 3-unit, or a 4-unit. Typically, if it's owner-occupied and it's a 1-unit or a 2-unit, we can put down as little as 5%. If it's a 3-unit or a 4-unit and you're living in at least one of these units, we can do an insured mortgage with as little as 10%. So we get asked these questions all the time. Like I own a principal residence, but I want to buy, a 2-unit property. And we always ask the borrower initially, is it going to be a full rental or is this really going to be a second home? Because oftentimes people will buy a 2-unit and they'll allow maybe a family member to live in the other unit, rent free, and then maybe they'll rent the second unit. That is an option. It's very common for people to buy a 2-unit property and let maybe a parent live in the property or maybe a sibling live in the property on a rent-free basis. As long as we don't need to use the rent for both units, then that could be considered an owner-occupied rental, which really enables you to get in with a much lower down payment. And what percentage do you need? Typically, if it's a full rental, you need a minimum of 20% down. And rental properties cannot be insured with the Canadian Mortgage and Housing Corporation, Genworth, or Canada Guarantee, unless it's a multi-unit. And what a multi-unit means is really above a 4-unit property. So that would be, I did one the other day, it was a 10-unit property. And the borrower put down 15%, and that we were able to insure with the Canadian Mortgage and Housing Corporation. Those files are much more challenging, and typically we'll only look at what we consider a commercial rental for a minimum purchase price of $500,000. So that's typically the rule of thumb. The commercial rentals take a lot of work. I worked on one file over the last few months, and I'm about 80 hours into that file, which is pretty extreme. Typically for a residential file, we spend 5 hours. So as you can imagine, it's a lot more work. And typically in commercial, the borrower will pay us directly because we're not paid by the bank. So just to recap, if it's owner occupied as a rental property, single family 2-unit, you can do as little as 5% down. If it's a 3 or a 4-unit, it's a minimum of 10% down. But if it's a full rental, no matter if it's a 1, 2, 3, or 4-unit, you need to put down a minimum of 20% and maybe more, just depending on what your situation is. And everybody's situation is a little bit different. And I think that's why people really love coming to an unbiased mortgage professional like us, because we can look at your income and your assets and your credit and really figure out what the best way is to move forward. What can you use for your down payment? Great question. Get asked this question all the time. You have a number of options. You can save it. You can use an RRSP, a TFSA, savings, tax refunds, gifted down, and borrowed funds. So that being said, for a full rental, you cannot borrow it and you cannot get it gifted unless we do a mortgage through the alternative channel. And an alternative mortgage, you're looking at a rate of maybe 5 or 6% on a rental. On a like a normal A lender in terms of rental property, you're looking somewhere around the 3% mark. So it definitely makes more sense to do an A channel mortgage if you can qualify. So that would either need to be savings or really borrowed funds in the sense of borrowed against secured real estate. If you're going to try to borrow it from a loan or a line of credit, that would really push you into more of an alternative style mortgage. So really, we want your own skin in the game when you're buying a rental property. And that means that you need 20% down. The other types of down payment, like the RRSP potentially, gifted funds, that could be acceptable for an owner-occupied rental. So how is rental income calculated and how do we verify it? Typically, we use 50% of the rent to add it to your gross income to be able to qualify. And that can be very challenging for borrowers because just imagine if you have your own principal residence, you have to be able to service that debt. You have to service maybe any car loans or credit cards, and you need to be able to service the new property. But not every lender calculates it like that. There are some lenders that will do what we consider a rental offset. That's what we know. That's what we know is kind of the old school way of doing it. It's much better for you. Typically, the way that that works is we still use 50% of the rent, but we'll allow that 50% to service the mortgage payment only. We don't add it to your gross income. We just service the mortgage payment. So as long as, for example, let's say the rent is $2,000 a month, as long as the mortgage payment does not exceed $1,000 a month, that would be considered a full wash. So 50% of the 2,000 is 1,000, and if the mortgage payment's 1,000, you're not having a loss and you're not having a gain. So that's what we consider a wash. The majority of residential mortgage lenders, though, will take that $2,000 a month rent, divide it by 2, which is 1,000, times it by 12, that's 12,000, and they'll add the 12,000 to your normal annual income, and then you need to service your situation and the situation for the new property. We can certainly go through the numbers. We can figure out which way makes the most amount of sense for you. Typically, if we can do a rental wash, we will do it because that's always better. Credit. Rentals are riskier types of transactions because, if something goes wrong in someone's life, chances are they're going to make the mortgage payment on their principal residence. But sometimes the mortgage payment on a rental property is not as much of a priority for a borrower. So typically lenders want borrowers that have a stronger credit history. And that doesn't mean that, if you've had credit issues in the past, you're not going to get approved through the A channel, but they want cleaner borrowers. And there are alternatives because we deal every day with alternative lenders. It's just maybe we need to do like a year with an alternative lender to get your situation cleaned up and then bring you into more of a bank style lender. And we can go through this. Typically what we consider good credit in terms of doing a mortgage for a rental property is no previous bankruptcies or consumer proposals, anything on the credit bureau, no missed payments, judgments, collections, none of these type of things. And we want borrowers to really have a credit score of 720 or better. That doesn't mean that we can't get it approved with a 700 credit score, but obviously we want it to really be clean, clean, clean. We do have borrowers that come in and sometimes they have damaged credit. That's reality. But typically, if we have that type of situation, we'll go to an alternative lender for a year, hopefully get their credit cleaned up, and then move it into another product. Should you buy it in your own name or a holding company? This is really a question for your accountant, but that being said, if we want to do a residential mortgage, guess what? Residential mortgages are most typically and easily obtained in your own personal name. And a lot of people want to buy them in their own name anyway, because they don't have to worry about filing another tax return. They don't want to have to worry about accounting issues. They don't want to worry about potentially selling it and then figuring out what they're going to do with that money. And typically when people buy rentals, they're not a huge moneymaker. Maybe they'll break even and they're going to be able to service the debt. But even if there is a loss, that can be claimed against your personal income if it is in your own name. If we're really looking to get the best rate and the easiest process, having the property in your own name is going to be the easiest way. When we get into holding companies, there's very few lenders today that will lend in a company name without either doing a commercial mortgage, which is very costly and can take some time, or an alternative source. So the easiest and path of least resistance is to do the title and the mortgage in your personal name. What else do you need to know? Well, I think there's lots of things. Where really are you going to get the down payment from? I think that's the number one issue. The majority of the borrowers that I see every day, are borrowing either from themselves, so they have money in savings or a TFSA, or we're doing a refinance on their principal residence. So if we're looking at doing a refinance, we can also borrow up to 80% of the market value of the home. So let's say you have a property and it has a $300,000 value. We can do a new mortgage up to $240,000 to pay out the existing mortgage and to give you the funds for a new property. We see this all the time. It's a great source for the down payment. Sometimes some borrowers will start with an owner-occupied rental, maybe buying it as a second home, just so they can get going, because coming up with 20% can be a struggle. But maybe we can get you into the first one with 5 or 10% down, and then you can build some equity into 2 properties and potentially refinance down the road to get into the new property. There's lots of things that we went over on the webinar. I think everybody's journey is individual, and I really think coming in to see me or see someone in our team definitely has a lot of value, and we can really look at your situation on a case-by-case basis. Everybody's situation is a little bit different, and we really want to be able to provide the best unbiased advice to each borrower, and that's really what we're here for. Let's get into some questions that were submitted by you guys. So first one, and just as a reminder, down below on your portal here on GoToWebinar, there is an area for you to ask questions. So feel free to ask any questions in there as we go through. So the questions that are here on the screen and everything that I've gone through for the last 15 or 20 minutes hasn't answered your questions, you can certainly ask the questions below. So here are some questions that have been submitted in advance. Do lenders recognize potential income from a rental in evaluating mortgages? So I assume by this question, what the person's asking is, if the property is not currently rented and we don't have a lease agreement, can we use the rental income? And the answer is yes, but it's good for us to know this up front. Not every lender will use a market rent analysis from an appraiser. And if they do use a market rent, potentially they want to cut down the amount that you're going to be able to borrow. But there are many lenders that will allow a market rent, and oftentimes we'll get a market rent and not even get any leases. The reason being is sometimes the lease agreements are outdated, sometimes the tenants change, sometimes the documentation is not that good. We like getting market rents. It's the easiest path. And typically we like working with lenders that will accept a market rent. So I think that's a really great question. And the unit doesn't necessarily need to be rented on closing, which is great. Let's see what the next question is. How to choose the right rental property to buy that will bring more profit? Great question. Again, I'm not an accountant and I'm not a licensed real estate professional, but I lend people money every day, and I've done, $500 million in mortgages, so I think I might have seen a few. And I've also owned rental properties myself. So I think it's hard to pick the right rental. But for me, I think looking at what the purchase price is and what the rental income is, I think are two things you really need to start with. So obviously, higher rental income, lower purchase price, that's going to provide you with the most amount of cash flow, which really, at the end of the day, everybody wants to make money. I think also looking at rentals that, maybe the tenant's paying their own heat. I really like that because, we always hear that old adage, the landlord pays for the heat and the windows are open in the winter and you're heating the outside. So I really like rentals where the tenant can pay their own heat. That's just me. But I really think that looking at the numbers and making sure the debt servicing is going to work, I think is the very first step. And for me, I really like 100% coverage because I know that it's really going to reduce my risk. So I look and see what my mortgage payment's going to be, and I typically want to bring in double in the amount of rent. So if my mortgage payment's going to be $1,000, I want to bring in $2,000 in rental income. So hopefully that's helpful. Number 3, what options are available for financing rental income property with a joint venture partner? Great question. We get asked this all the time. Honestly, probably a commercial. I think it's probably going to be the easiest path there. So when we're talking about multi-unit residential or commercial rental, typically above $500,000 I think doing a joint venture makes sense because you're going to get a commercial mortgage anyway, and we might as well put it in a business name. If we do a mortgage in a holding company name, there still has to be personal guarantees, the same as what it would be for a residential rental. So why not just do a commercial mortgage? So again, over 500K is typically the rule of thumb. And then we can certainly look at that. Again, those ones are on a case-by-case basis. Like I did one, actually I had someone in my office today, and they're going to do a 1-year rate at 6.2%. It's not the most ideal borrower, but we're able to get it done. And they're able to get the property that they want, and it has really good rental income. So I think the numbers work well for that one. Next question, should I buy close to where I live so I can keep an eye on things, or should I hire a company to look after everything? I've personally done both. I really like hiring a management company because I don't super love having the tenant know who I am. And I don't want to get calls in the middle of the night to be like, I broke my toilet, or, there's this problem. I think that there is a value with hiring a management company. Typically, the rule of thumb in terms of a property manager is you'll pay them about 10 or 15% of what the rent amount is. But the property manager doesn't get paid unless they bring in the rent. So I definitely see a lot of value in hiring a property manager, unless you're really trying to run this as a business. For me, I have a full-time job. I know many of you have seen me in the office or have seen somebody of my team. And I really don't have the time to chase people around for rent or deal with little problems. And I'm not that handy. So, I think hiring a company has a lot of value. I do, though, have clients that manage their properties themselves and they live quite close. So I think either way is viable. I think the most ideal is somewhere that's close to where you live and hire a management company. That really provides you, I think, with the least amount of risk. And I mean, there's pros and cons to doing it both ways. Who wants to give up 10 or 15% if they're just going to do everything themselves? But if you're a really good property manager, the property manager, I think, is worth their weight in gold. So, other questions? We kind of just blew through that in 23 minutes. Let me just see if anybody asked any questions here on our little portal. Thoughts on Airbnb? Great question. I see one popped in here. Airbnbs are tricky. I have had Airbnbs myself, and I think there's money to be made in Airbnb. But in terms of qualifying for rental income, Airbnbs are really tough. Lenders don't want to hear about Airbnbs. Even I have clients that own Airbnbs, and we'll just get a market rent. We don't try to do a 2-year average. We don't want to know they're renting it on Airbnb because the banks are not in the short-term rental game. They're not in student housing. They're not in rooming houses. They want long-term tenants because they think that provides the least amount of risk. They know they're going to get paid. Airbnbs can be great, though. You can make lots of money if you're willing to hustle. But I think that it would make sense to hire a property manager to run that Airbnb, in my opinion. What other questions? Oh, there's lots of questions in here. Let's just scroll down and see if we can see it. What are some of the general criteria for market rent? Good question. Market rent typically is done by a licensed real estate appraiser. So the same person who would do the valuation on the property would determine what the market rent would be. So typically we'll state what you believe the market rent is, and then we'll give those numbers to the appraiser to make sure that they're able to support them. Typically, you'll know what the rent is approximately. And then we'll go with those numbers, and we will then ask the appraiser just to support it. I think that's typically the way that we work it most of the time. So we have another question. You mentioned that you had rental units before. Why did you get rid of them? ... If you guys read my book, you would know. Those of you who don't know my story, I bought my first house when I was 19 years old because I'm like a wild and crazy person with my partner at the time. And we had leveraged that house to buy rental properties. And I was going through my undergrad at St. Mary's. And once I was finishing my undergrad, I'd actually asked a mortgage broker for a job and he didn't have any space for me. So I'm like, I'm just going to do this on my own. But during this process of us buying these rental properties, me finishing my undergrad, and we went through a breakup. As it happens, I'm sure there's lots of people that are on this webinar that have been through some type of marital breakdown or a relationship breakdown in the past, and we sold the properties. For me, I really want to focus on mortgage lending. I think that's what I do well every day. And I mentioned I'm not handy. So for me, I want to have less problems. And, you know, I really love rentals. I love financing rentals. But for me, in the place that I'm at in my life right now, I really am focused on kind of quality of life and having time for myself. And I don't really have the extra time to manage another property. Actually, just sold my house, so I'm quite happy. And I have one left to sell. So I sold my cottage in 2018, those who know me. And recently I just got a firm sale on another property that I built on the St. Margaret's Bay Road. So I'm quite happy about that. And I'm living in another house that's also new construction, and that's up for sale. So I don't know what's going to be next for me. Maybe it will be another rental. I am not certain. So do we have any other questions? I know we still have lots of people here on the webinar. You can certainly write your question in here. I'm going to stay on for another 2 or 3 minutes. So if you think of any questions, you can certainly put it in here. And for those of you who don't know how to get a hold of us, feel free to take a picture with your phone. We're located at 99 Wise Road, Suite 100 in Dartmouth. And you can send us an email, info@Team Clinton. You can check us out on the website, and our telephone number is there. And those who haven't been into the office in a little while, we did a major renovation over the holidays. Maybe this is where I'm putting all my money and time in this place, I don't know. But we did a major renovation here in our office, and you can see a little snapshot here on the left-hand side of our screen. We put up a feature wall of some textured wall material and a little LED poster, which is, and people get to look at my face all day, every day. I'm sure those people that cross the bridge or watch CTV or listen to the radio, they just can't get away from me, which I'm not going to complain. It's good for business. And we have another question on here. Actually, there's a few, so I'm just going to pop on here. Everyone on the webinar should get a free copy of your book. Oh, that's a good one. Maybe if you pop in the office, there might be a copy or two here kicking around if somebody maybe wants to borrow one. It's also available at the Halifax Regional Library System. So they have several copies that they bought from our publisher, and they're in circulation. So you can certainly sign it out of the library, or there's definitely a copy or two kicking around the office. So if you want to pop by and pick it up, you can read all about my life and I give my perspective really on mortgage lending. And I think it's the first book out there on the market that really talks to consumers about mortgage lending. And honestly, I've been able to compete on the national level from Halifax, which I think is pretty amazing. So hopefully there's lots of good information. I hope that you guys got really good information here from the webinar. I'm just going to see if there's any other questions on here. There are a couple more, so let me just see if I can swing through these quickly. Just one moment. Okay, I believe you said this already in your presentation, but lenders typically add 50% of the market rent on top of the gross income to determine the qualifying mortgage amount. That is true, that's the typical way, but there are some lenders that will do the old offset, which really means take 50% of the rent to qualify just for the mortgage, payment, which is great. How much time do you need to give until the closing date? Typically, the rule of thumb is we like to have 60 days. 57 days is the average. You know, we can do it in as little as 2 or 3 weeks. Some lenders really want a month plus. It just really depends on how busy they are and what their risk tolerance is to get it done quickly. You know, for me, I can hustle, so I can get stuff done in like a week or 10 days, but oftentimes the slowdown is with the borrower, not so much with the lender or the lawyers. So I hope there's lots of good information. Feel free to take a snapshot of our contact information here, and you guys know where to find us. Thanks so much for tuning in, and hopefully we will talk to everyone soon and see you in the office. Happy Tuesday. Thanks.